This is Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. A cautious open ahead for Asia after Wall Street gives up gains spurred by a cooler than expected US inflation print, Treasury yields falling on Fed rate cut bets, and a solid sale of a 10-year debt. President Trump declares the trade framework with China is a done deal that includes rare earth shipments, but exact terms of the pact still remain unclear. Plus, energy and transport stocks in focus as oil jumps the most since October, with tensions rising over nuclear talks with Iran.
Yeah, the U.S. staff, some of them being told to actually depart Baghdad. So we'll be watching those energy stocks, not to mention that we just got the headlines that President Trump is now saying that he'll set unilateral tariff rates within 2 weeks. So we might see a little bit more negativity across the markets in today's session. You can see Nikkei futures now down a third of 1%. This, of course, after gaining for 4 consecutive sessions. We had a little bit more weakness on the Japanese yen against the U.S. dollar. We had seen the finance ministry say that Japan will refrain from really those bond operation tweaks that were expected given the debt sell-off that we've seen in this country. Take a look at Sydney futures at the moment, gaining about 0.25%. But we'll be watching the offshore yuan as well. Not doing much right now, but we saw weakness in the previous session, both offshore and onshore as well. A little bit of sell the news after we got some more positive momentum coming from the trade negotiations in London. Not to mention, of course, we also have the dollar continuing to take a hit. Take a look at how U.S. futures are setting up. The dollar now at the lowest levels around 2023 or so. Now you can see U.S. futures down 0.2%, really taking a little bit of a hit. We had already seen losses in the overnight session. A little bit of perhaps profit taking, given that the S&P 500 was just about, 2% away from its February record highs. We'll be watching, of course, treasuries. We talked about the 10-year auction. We're going to get the 30-year auction as well. Not to mention that core CPI now really decelerating and coming in below economists' estimates for a 4th consecutive month. Take a look at crude prices, still extending those gains and nearing that $69 a barrel level, Heidi.
Yeah, take a look at really that market reaction that we're seeing, pretty much reflecting the immediacy of what we've heard from President Trump. Stronger yen, we're seeing VIX futures jumping, gold jumping, so a real haven reaction there. After President Trump said that he would set unilateral tariff rates within 2 weeks, comes after the US confirmed a trade framework with Beijing has been completed. Treasury Secretary Scott Bessent also spoke about that agreement with China in testimony to Congress.
China has a singular opportunity to stabilize its economy by shifting away from excess production towards greater consumption. But the country needs to be a reliable partner in trade negotiations. If China will course correct by upholding its end of the initial trade agreement we outlined in Geneva, and I believe after our talks in London they will, then the rebalancing of the world's two largest economies is possible.
Let's bring in Bloomberg editor John Hani and our chief North Asia correspondent Stephen Angle with the latest on trade. And John, let me get to you first in terms of the reaction of what we're hearing from President Trump speaking at the Kennedy Center, saying that he'll set unilateral tariff rates within 2 weeks. Quite vague in terms of which countries he's talking about, but of course there's some 150 countries, many of which are kind of in the middle of some point in negotiations. What's the sort of mood music here, given that of course they're coming off the back of what is being painted as a successful set of talks with China?
One thing that is certainly bolstering his position here is the court ruling, the appeals court ruling just last night that that allowed his trade regime to go forward pending further litigation. And that means that the deadline of July, which is, you know, in the first days of July, will stand for now, although there's been some flexibility even about that. Much, of course, remains with the China framework and other issues regarding trade, tax policy. Much remains uncertain, and markets are picking up on that.
And really markets picking up on what's happening with the shifting tone in the trade negotiations as well, right? Let me turn to you, Steve, because, of course, rare earths has become a centerpiece of the negotiation, so much so that perhaps U.S. export controls are also on the table.
Yeah, that's right. I mean, it shows that those export controls, many of which that the United States has sort of indirectly agreed to pull back, were added in the last few weeks, perhaps as added leverage, knowing that the framework in Geneva was fraught, if you want to call it that, because of what the White House claimed was China's backtracking or slowing down of the export licensing processes of those critical rare earths, and in particular, the rare earth magnets. So things are negotiable in the Trump administration. Donald Trump is essentially saying, after those 20 hours of talks over 2 days in London's Lancaster House, that the deal is essentially done, returning to the framework agreement in Geneva 4 weeks ago, and that essentially China will provide those critical rare earths up front. But that's, again, up for interpretation, because China, throughout this process, has learned that it has a very critical leverage tool of its own, and that is those rare earths that the United States supply chain, defense industries, aeronautic industries are dependent upon. So they also have an export license mechanism that they've put in place, China has, and I wouldn't say that they're necessarily have agreed to dismantle that. They're going to likely keep that in place in case this relationship goes sour again or pear-shaped again, because I think we need to be optimists smothered with a huge dollop of pessimism sauce, because, again, the fundamental issues between the U.S.-China trade relationship have not been resolved by this, and there's different interpretations. And the U.S. interpretation, whether it's Howard Lutnick, Jameson Greer, or Donald Trump himself, Scott Bessent, is that if China does this, the U.S. will do this. That's putting the onus on China to act first. So that might be a little bit of a sticking point.
Yeah, pessimism sauce, really, the G7 drenched in it, it seems right now. John, let me turn to you, because, of course, we do have the G7 leaders meeting, but they're not even going to try to get to a joint communique at this point?
Well, given the disagreements between the Trump administration and the president and the other members of the other partners in the G7 over, let's say, Ukraine, let's say trade policy, let's say climate change. The idea here is to avoid public discord, and that was the approach taken by Mark Carney, who, although he ran and won election recently by standing up to Donald Trump, wants to make an accommodation with the United States and prefers obviously prefers good relations as an important neighbor and very important trading partner. So, but to give you an idea of what this means, or some idea what this means, the communique in the last G7 ran to 36 pages, and even that was considered short, or shorter than previous ones. So it'll be quite a session with special guest stars, Modi of India, Sheinbaum of Mexico, and President Zelensky of Ukraine.
Steve, it's interesting. We haven't heard sort of nearly as much confidence or exuberance or really details out of Beijing, right? Are we expecting them to kind of support the narrative that we're hearing from Washington?
I don't think they're going to support that particular narrative, other than to say that they reached consensus. Now, it was interesting yesterday, Jeff Moon, who's a former assistant U.S. trade representative, essentially said when the Chinese, and he dealt with the Chinese a lot, when the Chinese start using the word consensus, that indicates that they are closer to starting negotiations than the end of negotiations. I thought that was a very interesting point. I think there is a trust deficit here between China and the United States, as evidenced by He Lifeng, the lead negotiator from the Chinese side. In a statement read out by state media, he said, as a next step, the two sides should follow the important consensus and requirements reached by the two heads of state on that phone call. The two sides should show the spirit of good faith in abiding by their commitments and jointly safeguard the hard-won results of the dialogue. Contrast that to Howard Lutnick on CNBC. He says, if you want to annoy us, the U.S. under Donald Trump is strong enough to annoy you back equally. So that was essentially, talking about if China doesn't do this, we are not going to relax those export controls that we put in place in the days after that Geneva consensus. So again, we're at a tenuous point right now in this relationship. It is a bit of a battle of narratives. China's kept pretty calm and kept its narrative close to its vest. But I can guarantee you it will use those export control and licenses of rare earths as leverage if things turn sour.
And Secretary Bessent, also, of course, a key player here, didn't necessarily say that much or provide that many details in his U.S. House testimony. John, when it comes to the tax bill, of course, you had lots of to say on that. What was sort of the tone, especially to do with the U.S. debt burden at this point as well?
He came back to Capitol Hill, spoke before both the House and the Senate after being in London. He played the part, as Treasury secretaries often do, of soother in chief, perhaps, of the administration, although not soothsayer. As far as the deficit or debt, he was circumspect when asked if the tax bill, a giant tax package, is now in the Senate and will have to go back to the House once agreement is reached in the Senate, that he couldn't promise whether or not it would add to the deficits. Now, but at the same time, though, he staunchly, vigorously defended the tax plan, praised the Trump administration for the pretty good or relatively good inflation numbers that came out today. And as far as a framework, the China framework, he basically said, don't expect finished carpentry. It's under construction. So it'll take some time for this all to play out.
Bloomberg editor John Harney and our chief North Asia correspondent Stephen Engel there with the latest on the U.S.-China trade negotiations. And as John just mentioned, that will, of course, take a long time to play out. And in the meantime, we're already seeing the reaction in the markets. President Trump just saying that he'll set unilateral tariff rates within 2 weeks, and you can see the Japanese yen now strengthening against the U.S. dollar. So these risk-off moves across the board. Gold also gaining ground. VIX futures rising. We saw a dip when it comes to U.S. futures as well. For more, let's bring in executive editor for Asia Markets, Paul Dobson. Paul, is this just another knee-jerk reaction to whatever headline right now President Trump gives us, or could we expect a change in the fundamentals of the market dynamics?
It feels, there's a little bit of jumpiness on the headlines. Not extremely big moves this morning on those latest ones. 0.2% on the yen doesn't exactly scream that people are running for the hills, Shery. But we are, as we know, subject to that continuing risk of whatever mood the U.S. administration seems to be in. I thought that the market might have taken more heart from what we heard from Bessent in the US day today, talking about the idea that if countries are negotiating earnestly, then he would be open to extending tariff deadlines. What we've heard from Trump just now doesn't offer that same sort of open door in quite the same way. So it'll be interesting to see where we wind up with the deadline coming now on the horizon. People are starting to look forwards to that, and not that many deals already in place. And obviously China sucked up quite a lot of time when they could have been talking with other people. So we're back to paying attention to those front runners, India, Japan, South Korea, who've been in those talks with the US and had some positive mood music. But even there, we haven't actually got the contours of a single done deal yet that we can really sort of use as a blueprint or a guide to what might be possible for other countries as well.
Paul, of course, we talk about sort of sucking up the time and the oxygen in the room at a time where there's growing concerns about the fiscal situation, what's going to come when it comes to treasuries. We're still waiting for another key auction on the Thursday, but take a listen to what Jeffrey Gundlach had to say.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
Well, what do we see in the markets that potentially there are segments of investors that kind of share this view that the long-term Treasury bond is not a legitimate flight to quality asset, according to Gundlach?
Yeah, well, that's certainly the thing that the market has been turning over in the last few months. Remember, we had the downgrade from a third rating agency not too long ago. That started to raise those concerns or renew those concerns. We've got the big bill going through negotiations at the moment, and that's going to most likely raise spending, raise the deficit, raise debt levels further. And people are, genuinely starting to worry about how that all plays out in the bond market, whether the US can continue to bring in enough interest to continue to sell that debt. And we've seen a much steeper yield curve this year. Short-term interest rates are down, long-term interest rates are up year to date, which shows you that it's really that sort of like longer-term debt that is causing the market some angst and concern at the moment. All that being said, yesterday was actually a pretty good day for the Treasury market. Not only did we have lower than expected inflation number, which helped lift bonds initially, but the auction of the 10 years that we saw yesterday due strong demand metrics right across the board. It was very well taken down. It was very well received. There was a lot of indirect bidding going on, not just from the primary dealers as well. And even at lower yields, people were willing to show up for that one. So far, so good. Today's auction, tomorrow if you're in the US, is going to be of the 30-year debt. So that will again be something that we're going to have to pay an awful lot of attention to. Is demand going to surface there? Are people still willing to fund the US? You get a very attractive yield on it. I'm above 5%. On the other hand, Gundlach was talking about the possibility that it might go up to 6%. He's not interested in buying, and I think that there are a lot of people that hold the same view as him now.
Bloomberg's Paul Dobson there. Coming up in the Asia trade still, we speak to Chinese social media platform Zhihu about AI and growth strategies, and the New York-based ETF provider Global X will be along with us to tell us how investors can better target US economic strength amid the ongoing tariff and trade uncertainty. Much more ahead. This is Bloomberg. We are looking at live images there of a federal detention center in Los Angeles. Protests over these immigration raids that began in LA have now spread to other US cities, including major cities like New York, Chicago, Milwaukee, with clashes between protesters and police. The downtown area of LA that's at the forefront of these tensions will also remain under curfew for a second night. Let's get some more with our Bloomberg reporter, Eliyahu Kamisha, who joins us now. So, as we see this spreading throughout the rest of the United States and a number of these major cities, what is the sort of status at the moment when it comes to what's going on in LA?
Yeah, well, LA is entering its second night of curfews, and the mayor has said that this could extend indefinitely depending on the situation there. There is kind of a bit of a lull relative to what happened over the weekend. Last night, about 15 people were arrested. And the kind of clashes and face-offs between protesters and Los Angeles police have quieted a bit with that curfew in place. So from the mayor's perspective, at least, that does seem to have been successful in getting some a grip on the situation and not letting it spiral more out of control.
Given also that you have, of course, the National Guard troops, the Marines as well. Now we're hearing that the National Guard is, in fact, directly helping ICE officers with immigration-related operations. What's the status there?
Yeah, so there is about up to 4,000 National Guard troops that have been sent by President Trump over to California. And they are helping some immigration enforcement, where essentially they're being seen protecting immigration authorities as they carry out these raids on different businesses and locations. They are scattered throughout. Sometimes their role is unclear. They're also at federal buildings, but they are now, on the streets of Los Angeles in different places and around Los Angeles, acting in coordination with the deportation campaign that's going on.
We know that the courts, in terms of action they could take, are fairly slow-moving compared to at least what we're seeing develop, from hour to hour and day to day. But what are we expecting from this court hearing when it comes to potentially limiting the use of these mobilised troops? And we know that some 18 other attorneys generals from around the US have supported this court case as well.
Yeah, it's hard to say. The Governor Newsom of California wanted an immediate injunction. That court hearing is now scheduled for Thursday. It's really hard to say where that's going to land, but that is really the kind of main avenue that the governor of California has to oppose this activation of the National Guard and of Marines in California. Beyond that, it's a lot of rhetoric, but so they are putting a lot of hope that the courts will step in and curtail this deployment of federal forces.
Bloomberg's Eliyahu Kamishir there joining us from California as we continue to watch the ongoing protests in Los Angeles. This is Bloomberg. You're watching the Asia trade. We're watching some of those oil moves with the price of that commodity surging. The U.S. has ordered some staff at the embassy in Baghdad to leave, while family members of U.S. military personnel in the Middle East will also be allowed to depart. Statements announcing the decisions did not cite any specific threat, but President Trump told the New York Post he's less confident about negotiations to impose new limits on Iran's nuclear program. Tehran, meanwhile, warned of retaliation if the talks collapse and it comes under attack. UK Finance Minister Rachel Reeves has announced a funding boost for health, defence and infrastructure in a spending review seen as a watershed moment for the Labour government. The NHS will see a 3% rise in spending in each of the next 3 years, amounting to $39 billion. Reeves also confirmed tens of billions of pounds of new funding for infrastructure and public services.
We are renewing Britain. But I know that too many people in too many parts of our country are yet to feel it. This government's task, my chance, a task as Chancellor, and the purpose of this spending review is to change that.
We have more ahead on the Asia trade. This is Bloomberg.
CFO turnover hit a record in the first quarter, with Russell Reynolds Associates reporting 95 changes at listed companies around the world. For more, Bloomberg senior editor Nina Trumpman joins us now. So, Nina, what are the sort of details in terms of what we're seeing around higher turnover when it comes to companies' finance chiefs?
Yeah, I think what we're seeing and what we have seen in the first quarter is certainly that the CFO job is getting tougher in this current environment. We're facing, of course, the U.S. administration, tariffs, uncertainty, volatility in markets. And what I'm hearing from recruiters is certainly that they're saying companies are taking a closer look at their CFOs, and they're finding that not all CFOs are the best equipped or the best fit in the current situation. And that's something that is expected to continue in the second quarter as companies position for lower growth and for potentially a recession, which of course then also means that you need a different kind of CFO, like somebody with a lot of experience as opposed to first-time CFOs.
Tell us about your recent conversation with the CFO of Reddit.
Yeah, that was an interesting one. He, of course, told me about his favorite subreddit, which was on dad jokes that he told his children. So that was an interesting one. We also talked a little bit about the monetization strategy that Reddit is pursuing, including, of course, revenues coming from advertising, as well as the data licensing deals that they have with companies like Google and OpenAI, where they let these companies use some of the content on Reddit to train their AI models. So that was certainly an interesting thing. He also provided a bit of an outlook on what they're seeing in terms of clients and spending. So yeah, it was a pretty interesting conversation, and it's an interesting space to look into.
Nina, stay with us as we bring in our next special guest. And Zhihu is a Chinese online knowledge-sharing platform touting deep AI integration as one of its key efforts to improve the user experience. Let's bring in the CFO, Han Wang, who joins us now from New York. Han, really great to have you with us. So you've had your first profitable quarter as a company. Tell us about the outlook and also what you're looking ahead to in terms of fundraising and investor interest, given that I assume that's why you're in the US at the moment.
Hey everyone, yeah, so this year we lowered our loss a lot. You know, like 2023 we lost $100 million that year, but now actually we have break even last Q4, and then we have another consecutive profitable quarter this Q1, and then we want to keep this trend. So we want to let people know that we have a very sustainable core in our core business, and it's and then we can be a sustainable break-even business with a lot of AI potentials in the future. Yeah, and then came to the US. We feel that a lot of people don't know us, so I think there's low-hanging fruits for us. So people are just asking us very basic introduction about what you are, what you're different with search engine or something. So I guess if people know us more, I think they will feel our value in the market.
Han, just following up on that, I'm just wondering in terms of the outlook for the business, of course, some of your revenue is also generating from advertising. I'm wondering what you're hearing from clients in the advertising space from China these days.
Yeah, definitely in China, more and more clients are more cautious about ROI. So actually, people want a clear ROI in this environment. That's for sure. But actually, I think people are also exploring the new opportunities. So they are very excited about the AI initiatives we're having, because everybody excited about AI and actually is thinking about what AI will change the landscape, and they can tell that in a lot of search AI bot, there's a lot of content are cited from Zhihu. So actually, a lot of advertisers would go to us proactively to ask, is there any AI companion or project that it can be involved to, so that if you have more content or Q&As in Zhihu, so maybe their content themselves can be shown. Can be mentioned within the result that chatbots gave to the users.
Han, just wondering, actually, given that you also describe your company as China's Reddit, I'm wondering, based on the recent conversation that I had with Reddit's CFO here in the US, this idea around using some of your content for data licensing, for then training of AI models, is that also something that Zhihu would look into in future?
Well, the fact is all these big companies has been reaching out to us because they have all the people know that we're the best source of content in China. So they have reached out to us, and they have done some a little bit testing, and the result is also that we're the best. So the next step, we haven't we're still exploring how to carry on this practice, but our data quality has been proven.
I'm just wondering, actually, in terms of the view of the consumer, that's of course probably also something that you're seeing from the business. You have a lot of subscriptions you have people paying for subscriptions at Zhihu, and you also of course have a lot of, as you pointed out, user-generated content. What's the sentiment amongst Chinese consumers these days?
The sentiments on users I mean, paying for the content, or is that a?
Yeah.
Okay. I mean, you know, I mean, people are more like would love to pay for subscriptions. You know, you have seen several like subscription business has been profit in China market, and any AI actually people have to like pay at the first day like upfront. So I think people would love to pay more in this area. Yeah.
I'm curious, how do you sort of feel the broader environment and the mood music is right now as a Chinese company in the US looking for investment, looking at that secondary listing? Have the sort of geopolitical tensions, the trade talks been felt by you?
Yeah, so, you know, obviously you can tell from the market cap that, I mean, there's a real impact on the market cap, on the stock price. But actually, we just came, like these 2 days, we have several meetings. So there are a lot of people just came to us, and they introduced themselves as we're a small to mid cap company, and like they think it's pretty stupid to ignore China as the biggest, as the second biggest market in the world. So a lot of them would love to still like have allocations in China, and then or they want to like bring the allocation back. So I mean, we have met several investors, and actually we have several investors has been like building up position, obviously on us. I mean, like Fidelity or other like long onlys has been like building like significant positions within the couple of quarters, Q4 and Q1. So I mean, we don't need to convince all the investors. Only several investors will move the needle, since we're not a huge company.
Han, I'm just wondering, in terms of the outlook for you as a Chinese business, with also shares trading in the US on the New York Stock Exchange, do you think with this improved sentiment between the US and China, based on the trade talks that are ongoing in London, over time that there will be more investor interest in companies like yours, and that you will regain some of that market cap you lost, maybe because you're a Chinese company?
We already feel that a little bit. You know, within these trips, I mean, these bankers, I mean, they're arranging the meetings, right? So they can also feel that the sentiment is back a little bit. So yeah, so we already feel that a little bit.
Han Wang, really great to have you with us. Zhihu CFO and Bloomberg's Nina Trepman there. Our CFO briefing is a weekly newsletter featuring top executives at global companies and key trends in corporate finance. Subscribers can sign up on the Bloomberg.com link or on the terminal. More ahead on the Asia Trade. This is Bloomberg.
Toyota Chairman Akio Toyoda is expected to retain his board seat at the automaker's annual meeting today, despite concerns over his role in a controversial group company takeover. Let's bring in Bloomberg Intelligence senior analyst Tatsuo Yoshida. Tatsuo, of course, we are watching the Toyota Industries privatization, but also at the same time, there have been some concerns about corporate governance around Toyota and around Akio Toyoda even before this.
Oh, yeah, that is correct. And recent move to the privatization of the Toyota industry, that kind of amplified the concern.
But what is the issue with Toyota Industries? Because you would think the Japanese government wants to simplify these cross-shareholdings. Wouldn't this be actually a good thing?
Actually, that is a plus. That's a positive aspect of this privatization. But looking at the structural ownership of the Toyota Industries, it's owned by the Toyota Fudosan, used to be Towa Fudosan. That holding, almost like a holding company, holds 99.5%. And then Akio Toyoda has remaining 0.5%. So it's the Toyota industry is owned by the so-called Toyota Group.
What are the biggest concerns from major investors about governance?
Actually, governance-wise, too much influential power of the Toyota Group as well as the Akio Toyoda.
So What is Akio Toyoda saying himself? How is he justifying this?
Actually, Akio, he himself said, I'm not going to influence the company too much. Instead, this is more like a symbolic role.
We have to take his word at face value. Okay. That was great to have you with us, Tatsuo Yoshida, Bloomberg Intelligence senior analyst. Heidi, of course, as we continue to watch the Toyota stock, we'll be watching that trading as we get the annual general meeting today.
So, Shery, we're watching this survey by Bloomberg Intelligence finding that over 64% of car buyers are opting for new energy vehicles versus 57% last year. It's mainly being driven by an interest for plug-in hybrids. Let's get to our Bloomberg Intelligence China auto analyst, Joanna Chen, who joins us out of Hong Kong. So tell us about the takeaways from this latest China car buyer survey.
Yes, hi. So our car buyer survey basically serves as a lead indicator to show how consumer preferences and also market trends are evolving across markets. We do that in China, in Europe, the US, and also Japan. So to your question, in China, we are definitely seeing the new energy vehicles continue to gain more interest and continue to squeeze out the traditional gasoline cars out of the market. Yes, we definitely saw that 64% of our survey respondents saying that they want a new energy vehicle versus 57% last year. And if we break down the numbers, it's a little bit more interesting. We see that battery electric vehicles are still the most popular powertrain, with 1/3 of survey respondents saying that they want a battery EV for their next purchase. But if we compare that to the 2024 result, it's basically flat line. So what's really driving the rise of interest in new energy vehicles is actually the plug-in hybrids, according to our survey. And that's because some consumers are still worried about the battery performance and charging concerns. We are seeing that this kind of ultra-fast charging technology is emerging in China, but infrastructure will take time and investments to keep up. So until that is ramped up, we think that plug-in hybrids will still be one of the pretty dominant powertrain in China, and that means that for automakers, they probably need a very strong and balanced model portfolio in both battery electric vehicles and plug-in hybrids, so that they are set for long-term sales strength in the market. Because for the next couple of years, we're still seeing that battery EV and plug-in hybrids coexisting in the market.
So we can see right now the subtle differences between the 2024 and 2025 survey when it comes to brand popularity. But tell us a little bit about the competition. How competitive is this environment? Because, of course, the key issue right now is the bottom line.
Yes, the competition is fierce in China. We saw we asked them what are the brands you're preferring for your next purchase. We do see a lot of reshuffling, and overall, the homegrown brands are gaining more interest in our survey. And we see that BYD climbed to the top, and then Tesla slide to the second place in our ranking of most popular brands. And what really it's kind of different in our this year's survey is that Xiaomi climbed really fast to the 4th place, and the votes are only marginally below BMW. Xiaomi, they only debuted their first EV in early last year, and it's just been a year, and their EV, the SU7, is outselling Tesla's Model 3. And people are waiting for 11 months to get delivered if they place an order for a Xiaomi car. So we think the demand hasn't been fully reflected in sales number because of their production bottlenecks. And once Xiaomi ramps up their second SUV model and also the second factory, that makes Xiaomi a really serious contender in the China EV market that will give more competitive threat to especially Tesla and NIO, whose EVs are priced similarly versus Xiaomi.
We've seen more than 2 years of hyper-competitive price wars, right? Has that done damage when it comes to brand reputation? Is that really a key sort of marketing focus now for these makers?
We are definitely seeing that because of the price competition, brand loyalty has been plunging. More and more consumers saying that they are likely to jump to other brands, or they have no preferences in terms of like which brands they look at, and they are more caring about product specs and also the pricing and other kind of more related to product itself instead of the branding. So that means the competition is rife for automakers. They have to make their products really competitive in terms of pricing, specs, and also software to attract the Chinese consumers. They don't really have much pricing power in this market. It's consumers who make decisions now.
Bloomberg Intelligence China auto analyst Joanna Chan there. Take a look at how we're setting up. We're just about, 12 minutes away from the start of cash trading here in Australia, also in Japan as well. Asian stocks are looking like we might see some renewed downward pressure risks right after President Trump saying again that he'll set unilateral tariffs in 2 weeks, planning to send letters to trading partners in the next 1 to 2 weeks ahead of that July 9th deadline. He has threatened to impose those high duties on dozens of economies. At the moment, we've only seen a trade framework with the UK, a truce without many details with China that was recently under threat as well. But a lot of other bilateral deals are still sort of in the state of discussions, including major ones, the likes of Japan, India, South Korea, the EU still very much up in the air. Sydney futures up by about 0.2%. We're seeing some negativity last traded when it comes to Nikkei futures, and S&P futures also looking a little bit softer as well. We see that haven demand starting to play out as well. The undermining of the US dollar continuing to be that narrative. We could see a bit of an edge when it comes to Asian currencies, already getting that boost from the slide in Treasury yields. We had, of course, the benign inflation report overnight as well. That sort of fears of a reacceleration in prices, and now more expectations of Fed support are kind of more in play in that market mood. More ahead on the Asia trade. This is Bloomberg.
DoubleLine Capital CEO Jeffrey Gundlach believes America's debt burden and interest expenses have become untenable. They may lead investors to move out of dollar-based assets. He spoke to us exclusively at the Bloomberg Global Credit Forum in Los Angeles.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so. Or 2005, and there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position, and the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so this is a moment where finally you have the setup where non-US investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves away from the US.
Trillion.
Right, exactly,
yeah.
Whatever it is,
yeah.
3 trillion. You're getting trillions of dollars moving out of US assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been
about
thinking
shorting
about
it?
this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot, because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say, this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing.
DoubleLine Capital CEO Jeffrey Gundlach there, speaking exclusively with Bloomberg's Lisa Abramovitz. Let's get to some of the morning calls that we're watching ahead of the Asia trading day. PIMCO sees a tactical opportunity for long-dated Japanese government bonds after a surge in the 30-year yield to record highs. Global Fixed Income CIO Andrew Bowles told Bloomberg that the bonds look really interesting. He also told us that he views it as a short-term trade rather than a long-term play. Hedge fund founder Tudor Jones expects the US dollar to weaken another 10% over the next year as short-term rates fall sharply. He also believes President Trump may appoint a, quote, uber dovish Fed chair to support his growth agenda when Jerome Powell's term ends next year.
Short the dollar? I mean, you mentioned you're into yields.
I would say that the easiest long-term trades are, you know the yield curve is going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that. A lot lower because of that.
How much lower? I mean, we're off 10% from our high right now, 8%.
Yeah, I would say I think that's a year from today, that's probably a realistic assumption.
We're following the bond market moves, but on this trading session across Asia, we're seeing a little bit of that risk-off sentiment, with President Trump now saying that he'll set unilateral tariff rates within 2 weeks. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens with a little bit of caution, Haidi, spreading across the board right now after President Trump just said that he would impose those unilateral tariffs within 2 weeks. What that exactly means in terms of trading partners, in terms of rates, we don't know as of yet, but of course that really doesn't help sentiment.
No, it doesn't, and we could see that being reflected by some of that downside pressure here for Asia, right? But it's interesting, it also comes against a contrast of quite a lot of exuberance from the US side when it comes to what's been reached in this agreement with China, even as Beijing stays very much mum on those details. But you're right, realistically, there's a lot of other negotiations that are still on the table that we still don't know whether we're going to see progress, including major ones like the EU, like South Korea, like Japan.
Yeah, take a look at how markets are coming online, because we had seen the Japanese yen strengthen a little bit overnight because we heard from the finance ministry here in Japan that they had no plans to buy back JGBs. Remember, there was speculation that they might try to cap yields at the long end, given that ongoing sell-off, not only in Japan, but really globally. But take a look right now, because we're seeing more upside for the yen against the US dollar on that risk-off sort of move right now early in the session. Nikkei down 0.3% after 4 sessions of gains already. We're watching, of course, JGBs, as I mentioned, 145. On a week when we also have, we just finished a 10-year auction in the U.S. We're headed to another 30-year auction, so do watch out for that. Take a look at how the Kospi is coming online. We continue to see gains for the Korean stock markets, but those gains have been slowing down a little bit. Remember, 6 months of political turmoil ending, new president, a lot of optimism. We had seen the rally, the Kospi gaining 0.3% early in the session. We're seeing a little bit more upside for the Korean won as well early in the day, Heidi.
Yeah, take a look at what we're watching when it comes to just that staggered start to the cash trading session here in Australia. Watching those energy stocks, we've seen, 6 consecutive days of gains for oil stocks in Asia. A lot of those are heavily weighted in Australia as well. We could see a 7th day, although oil prices certainly starting to look like they're wavering a little bit of downside as we get that staggered start to the trading session, but quite hard to get a read, of course, until we're a little bit further along. The Aussie dollar at 65.11, benefiting from that sustained weakness that we continue to see in the US dollar. We'll see that as a trend for a lot of those Asian currencies today, I suspect. It's been pretty calm when it comes to treasuries with that overnight session, the 10-year auction, the sort of benign inflation picture. But of course, we're looking to that 30-year auction on Thursday, as well as some of the pretty sort of stark warnings that we heard from the likes of DoubleLine's Jeffrey Gundlach saying, like, that these sort of longer-term yields are headed for a reckoning. Let's bring in Scott Helfstein, who's the head of investment strategy at ETF provider Global X. Scott, a lot of headlines. It's never a dull moment. What are you sort of core focus at the moment?
Well, I think first and foremost, it has to be what has been really a ramp down in the tariff discussion vis-a-vis U.S. and China, and the fact that there seems to be, at least for the time being, a detente between the two countries and the provision of metals and materials to the United States, probably chips and technology back over to China, which helps to sustain the economy. So, unfortunately, in a sense, on a day-to-day moment, we seem to be living and dying based on geopolitical news. The reality, though, is that the U.S. economy is far bigger than whoever is going to sit at 1600 Pennsylvania Avenue. It's more complicated. It's more dynamic. And so what I really try and impress on people is step out of the current moment and still recognize that there is innovation around technology, automation, artificial intelligence that's going to continue to drive profitability.
So you don't necessarily subscribe to the demise of U.S. exceptionalism when it comes to U.S. assets?
So this is probably my most contrarian view at the moment, because certainly we have seen flows out of the United States. I do believe part of those flows isn't so much an underweight on the U.S. as a return more towards an equal weight. U.S. assets as a percentage, call it dollar of revenue to market cap, had grown so disproportionate to the rest of the world. U.S. stocks were just that much more expensive. And a lot of that was whether you were selling to the U.S. consumer, so you were perhaps China, somewhere in Asia, selling into the U.S. market, people left their profits in dollars and just reinvested in the U.S. So I think part of what we're seeing is a natural move towards a more equal weight, but we still subscribe to the U.S. exceptionalism argument. And I do think that what we're seeing in the dollar is potentially more of a short-term trade than a long-term trend.
That weakness that we're seeing at the lowest since 2023 and that move away from American assets, you think that the dollar will actually rebound from here? And when could we see that?
I think it's probably towards the back part of the year. I think we have to get past some of these concerns around trade. And what I believe really is happening for the administration is they're taking a bet. And the bet is the U.S. more reliant on cheap Chinese goods, or is China more reliant on the U.S. consumer? And for right now, I think that what we're kind of seeing is that the U.S. consumer is still tremendously important. As you noted at the opening of the show, the inflation picture has actually in the United States been a lot more benign than I think people expected. And so, quite frankly, our next revision when it comes to growth or earnings and profitability might be back higher. So ever since February, we've been revising the U.S. growth estimate downward. We're now sitting at about 1.4% consensus growth. Add on 2.5%, call it inflation. We saw 2.4 yesterday. So the real question is, can the United States beat 4% nominal inflation? And I think the answer to that is yes. 4% nominal growth. And the answer to that is yes. And so I wouldn't count the United States out, but I do think it's going to take, call it 3 to 6 months to work through this turbulence. And for the record, we still have these trade pauses, so we have not necessarily found our steady state yet. And so expect more volatility throughout the year, but don't let the volatility dissuade you from the longer-term secular stories around things like artificial intelligence and automation that are driving profitability.
But the thing about markets is that you always have to find the relative value, right? With the S&P 500 just about 2% away from a record high, would this still be the right time to put in more capital? And if so, would you then take away from, say, the Asian markets? Or do you keep diversifying given, of course, the uncertainty out there?
So one of the areas that we focus on at GlobalX is around thematic investing. And so certainly from an index perspective, the United States is back to where it was. Mind you, you're still talking about a market that has record profitability in terms of its profit margins and probably has continued healthy top-line growth. And so what drives multiples? It's usually a combination of profit margins and earnings stability. That said, if you don't want to look at the broad market, you could, for example, look at a basket of artificial intelligence stocks that have superior profitability, superior growth characteristics than the broad U.S. S&P 500, and yet it's selling for more or less the same multiple. And you can look, for example, at somewhere like robotics as well. So things tied to the automation revolution, because in the United States, if we're not going to enter the trade war with China, we should be back to a world where there is cyclical recovery and cyclical opportunities in areas like industrials, so think of robotics, in areas like copper and miners and materials. All offer, I think, superior fundamentals at still halfway reasonable valuations.
How much do you worry about broader geopolitics? The world is remarkably complicated. One of the themes that we track and that we continue to like is defense technology. Is that a Europe story, a German stock story? It is both a Europe but also a U.S. story, because when we are done with the big beautiful bill, most likely the next thing we are going to do in the U.S. is the first ever $1 trillion defense budget. So keep in mind, last year we spent about $842 billion. So if we went. And again, this is one of those policy on-off reversals that we have now been living through. So at the very beginning, we were talking about cutting the defense budget. Congress walked into the White House and said, this wasn't the plan. And we think we have to spend more. And by the way, what we're learning in areas like Ukraine is how new technologies, like drone technologies, are impacting the broader security environment. And that's going to require resources for us to continue to build up resilience to address in the future. And just, overnight, there was conversation about revisiting the UK, Australia, US Defense Pact, which in terms of the spending dynamic. And so all these things are on the table. But in the United States, if we get $1 trillion, so close to $150 billion, more than we spent last year, and Europe is talking about going to 2 to 3% for their, as a percentage of GDP, for their NATO military spend, that is a massive stimulus to that piece. And I hate to use the phrase, but it's the old saying: if you want peace, prepare for war. And so that seems to be where the world is leaning towards in terms of build-up. So do I care about geopolitics? Yes. And I also believe that, for example, a softening of U.S. relationships with China changes the dynamic for U.S. and Russia, Russia-Ukraine, and U.S.-Iran, and potentially even U.S. and North Korea. All of those things are sort of tied together. And the Trump administration has had some degree of success in dealing with these very, very thorny international issues. So while domestically people are looking at the United States and saying, what damage has been done to consumer sentiment and business sentiment, how long will it take to reverse if, in fact, we are going into, call it, a smoother economic and trade environment. Internationally, the administration has had some success. Scott, always great to have you with us, particularly great that you could join us here in Sydney today. Scott Helfstein, who's the Head of Investment Strategy at GlobalX. More ahead here on the Age of Trade. This is Bloomberg.
President Trump has posted that the framework trade agreement with China is a done deal that will include upfront shipments of rare earth materials. But exact details of the pact remain unclear. The president also says he'll be sending letters to other trading partners in the next couple of weeks, setting unilateral tariff rates.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is, like I did with EU.
For more on this, let's bring in our Chief North Asia correspondent, Stephen Engel. And Steve, this was really interesting to me when I was in South Korea, and I was getting the views from the ground from officials that were a little bit concerned that the U.S. was moving this fast with China. What would it mean for trading partners like South Korea when it comes to actually achieving a deal with them? Now we're seeing this renewed pressure on partners.
Yeah, I think the China deal was almost viewed in isolation to the rest of the trading partners because of the size of the deficit with China and the size of the grievances between the two countries. The rest of the world, if you want to call it that, is kind of been left hanging because the United States and its trading partners, they've only reached one deal so far with the UK. So that leaves, the White House to have to sort of prioritize which deals is going to serve its interests best in such a short time frame. Keep in mind that reciprocal tariff pause expires in less than a month on July 9th. So he mentioned 15 countries. Well, they put reciprocal tariffs on a lot more countries than that. He mentioned India, but also, of course, Japan. You mentioned South Korea. The EU maybe is going to be a more tricky one, given the grievances between those two sides. But it leaves countries like Vietnam, which was the great article on the Bloomberg terminal today about the impact, 46% reciprocal tariffs, which was placed on Vietnam before the pause. The tremendous damage is going to be doing to the Vietnamese economy going forward as it has really oriented itself into the global supply chain. I'm getting away from the bigger picture here, and that is once we've gotten those 2 days of talks in London over with, Trump clearly not wasting any time to say we're going to be sending out letters if they have to within the next week or two, essentially setting what the rate is going to be on those unilateral reciprocal tariffs, even though that deadline is coming in less than 4 weeks' time. He said at a certain point, this is what Donald Trump said, at a certain point, essentially the United States have to say, this is the deal, you can take it or leave it. That's where we're standing right now, obviously. But again, that's, working a little bit in isolation to those bilateral talks that happened in London over 20 hours over the last couple of days.
Yeah, pretty different tone and a lot more colour around what we've heard from the White House and the US Trade Representative side versus what we've heard from Beijing, right?
Absolutely different kind of narratives. Obviously, China is at least outwardly saying that they're fairly pleased with the outcome, but again, cautioning the White House too. And I will read a statement coming from state media attributed to the lead negotiator, He Lifeng, vice premier. As a next step, the two sides should follow the important consensus and requirements reached by the two heads of state on that phone call last week. The two sides should show the spirit of good faith in abiding by their commitments and jointly safeguarding their hard-won results of this dialogue. The statement, however, did not elaborate on the specifics of that framework. And the concern is, and why there's been a muted or mixed reaction on the markets, is because it seems as though the United States might be putting the cart before the horse, the old analogy there, as far as saying, Donald Trump saying that the rare earth minerals, the key ones that China has pulled back on the export licenses, they're going to be coming up front. And then as they do that, as Beijing relaxes, then the United States would relax its export controls that it added over the last 4 weeks as the bad blood added. So it's almost putting the impetus on China to act first, and then the United States will pull back on its move. So, again, that's probably not what China signed up for necessarily, but they are not revealing all their cards on the table. Meanwhile, again, those export controls that the United States might relax include chip design software, jet engine parts, nuclear materials, and also talking nice about Chinese visas or student visas to the United States. But again, Howard Lutnick, speaking on CNBC, he's the Commerce Secretary who's part of those talks. He said, and I quote, "If you want to annoy us," he's referring to China, "if you want to annoy us," and that's, I would assume what he's referring to is the slowdown of the licensing for rare earths. The U.S. under Donald Trump is strong enough to annoy you back equally. But again, Howard Lutnick is making the rounds on media in the United States. Speaking on Fox News, he said, we're in a super place with China. So it's a bit of a battle of narratives. The U.S. is speaking a lot more than China is right now.
Our Chief North Asia correspondent Stephen Engle there. And speaking of the US speaking a lot more at the moment, we're also hearing from the Commerce Secretary Howard Lutnick saying that he met with Keir Starmer yesterday and agreed to implement the UK trade deal as soon as possible. Let's bring in for some more on this, particularly as we've also heard from the Treasury Secretary as well. On the issue of trade, telling Congress that the US deficit for the current tax year will be between 6.5% and 6.7% of GDP. He did refrain, though, from arguing that the tax legislation Republicans are working to finalise in Congress will avoid adding to the debt burden.
What I believe is that everyone on the Democratic side voted for the biggest blowout for the deficit in history, and that we are suffering from that. This past tax year, we will have between a 6.5 and 6.7% deficit, so I find it very difficult to be lectured to by people who created the largest deficit in history when we were not at war and not in a recession.
Let's bring in Bloomberg editor John Harney in Washington. And, as trade, US-China trade in particular, but of course all of these other negotiations still on foot continue to suck oxygen and distraction from this administration. There's also a lot going on domestically. And, if you take a look at Treasury markets, just continued concerns about the fiscal situation in the US.
Well, that's true. Secretary Bessent, you could say, played the part in his two appearances on Capitol Hill today of soother in chief, not necessarily soothsayer, as Treasury secretaries often do, to reassure lawmakers, to reassure voters, and of course to reassure markets. That's particularly important. That role is particularly important now in a time of great uncertainty regarding trade, regarding tariffs, regarding other issues. Now, he, as you say, was fairly circumspect about whether or not the huge tax bill that's now in the Senate and will probably eventually go back to the House would add to the deficit. But he strongly and vigorously, as you also saw, defended it. Criticized Democrats for their running up the deficit themselves, and was very positive about the Trump administration's economic and trade decisions and agenda thus far. And this, by the way, was after he flew back from London from the talks with China, and about those he said that those expecting a complete picture, of what went on there, the framework, to be patient, not to expect. It was under construction, this agreement, and don't expect finished carpentry right away.
Which is quite interesting because President Trump has said that the deal and the framework were already done, right? But staying on the debt and staying on the deficit and just the U.S. economic picture, the whole idea is for Republicans that if you have a tax bill that helps the economy, that could offset some of those debt burdens, right, the deficit. What are right now the calculations by analysts of how much this will actually help the U.S. economy?
Well, I mean, there's been various estimates, been various calculations. And we still don't know, of course, how this bill that was passed by the House is going to be changed in the Senate and then perhaps being changed again when it goes back to the House. Like, for instance, the so-called SALT provision that so where people in states like California and New York with higher taxes are allowed to deduct those taxes from those states. And an agreement with the House, with Speaker Mike Johnson, with lawmakers from New York and California, this cap that was imposed when during the first Trump administration was going to be raised. Well, it may have to come back down in the Senate, but then that may upset the House. So an awful lot of, just like with trade, with taxes, there are an awful lot of, shall we say, moving parts. So it's unclear how this is going to play out. Secretary Bessent did say in his appearances today that the deficits are too high in regard to GDP, and it's about 6.7% now. He wants to get them back about half that, or a little more than half that, by the time at the end of the Trump administration in 2029. He also said that he doesn't expect to be the new chair of the Federal Reserve. There's been speculation about that in the last few days.
Bloomberg editor John Harney there. We do have more ahead on the Asia trade. This is Bloomberg. Take a look at European futures opening, as we heard from the Commerce Secretary Howard Luckney saying that he's met with the Prime Minister of the UK, Starmer, at Downing Street, and they've agreed to implement the UK trade deal as soon as possible, with the agreed quotas for UK autos and US beef and ethanol becoming, quote, simultaneously active in the coming days. This is a picture when it comes to what we're watching in European trading. Quite a bit of downside there, as reflected in the previous session as well. We are expecting a further move higher when it comes to the euro, with a downside in the dollar after the latest tariff threat.
China has a singular opportunity to stabilize its economy by shifting away from excess production towards greater consumption. But the country needs to be a reliable partner in trade negotiations. If China will course correct by upholding its end of the initial trade agreement we outlined in Geneva, and I believe after our talks in London they will, then the rebalancing of the world's two largest economies is possible.
U.S. Treasury Secretary Scott Bessent there speaking in Congress. Our next guest previously worked at the U.S. Treasury in the Office of International Affairs under Presidents Clinton, Bush, and Obama. With us now is Karen Mathiasen, Project Director at the Center for Global Development. Karen, always good to have you with us. So it seems that things are cooling off between the U.S. and China, but at the same time, President Trump now coming out saying that he will set unilateral tariffs within 2 weeks. My question here would be, will a U.S.-China sort of trade détente actually risk and threaten other trade deals with partners like South Korea, Japan, India?
Well, thank you, first of all, for having me on. And my answer to that would be no. I don't think so. I think that there's a real incentive to reach deals with other countries because we have a lot at stake with other partners, not just China. The real question is the when. You may recall the administration said it was going to deliver 90 deals in 90 days, which of course is not possible. So I am more curious to see what will happen at the end of the 90 days, and will they continue to just be a standstill to allow these other negotiations to go forward. And my guess is that there will be. I think that the sort of appetite for continued uncertainty, particularly in the bond market, is shrinking a bit.
Yeah, that veering away from potential U.S. assets, given, of course, the uncertainty just generally from U.S. policy, right? What has been achieved in London? Because it's very difficult for me to sort of discern if anything has moved forward from the Geneva talks back in May.
Yeah. So, as you say, it's hard to know. There's nothing in writing. We mostly have a few, proclamations on Truth Social and so forth. But as far as I can glean, there really has not been anything meaningful since April. To me, it looks like both sides kind of rose their weapons a couple of months ago, and now they're lowering them back. But that's as far as I think it's really gone. So not particularly meaningful in terms of concessions on key issues, but potentially meaningful in terms of offering some degree of stability, which I think is really what businesses and investors are craving. So even if we don't see anything significant as we get more information on the deal, if there's some hope that it will last, that tempers will cool, and that will prevail over time, that alone will be an important signal to the business community, I think.
Is it telling that we've heard a lot more exuberance from the Chinese side than the sort of colour that's been painted by the US? What does that tell you about potentially sort of the amount of leverage on each side and the potential for, this deal or this, sort of handshake agreement to say that a deal that was reached in Geneva is still a deal could still fall apart?
I think it speaks to the fact that, look, President Xi knows that he's got a lot of leverage, particularly with these rare earth minerals, right? They are so vital for so many industries, including in the United States, robotics and the U.S. auto industry. And we're already seeing a lot of turmoil within the auto industry from the other tariffs. So I do think that there's... that it's understandable that China would feel that they have some real leverage, both for that reason and because there's a willingness to let uncertainty linger longer.
You've worked at the Department of Treasury under Presidents Clinton, Bush and Obama. I do wonder from a bigger picture kind of, existential shift, if you will. How worried are you about all of the talk about, the demise of US exceptionalism, both in terms of geopolitics, but also in US assets, and these fundamental concerns building about the fiscal situation at home? Not to mention, some of the sort of other things going on, like protests across various cities and the such. There's a lot of distractions.
I'm extremely worried. As somebody who spent a quarter of a century almost at the Treasury Department, it really was such a source of stability in terms of policy and, focus on stable markets. And, regardless of administration, I felt there was a lot of consistency in terms of analytics and a real focus on evidence. And, this is a massive departure from those days. I really can't overstate how dramatic the shift is. And, partly, as you say, there's all the noise on the fiscal side, which is very significant. But partly it's this focus within trade and global imbalances on just the balance of trade. And, this is unprecedented, right? We always look at the current account at the Treasury Department. How are the trade and services together globally? What do they show us about global imbalances? And that, I think, just about every other economist will agree, that is the right thing to be focusing on. This very, very narrow focus on just trade in goods on a bilateral basis, I think is leading us down a very dangerous path, quite honestly. And I would say, sorry, just quickly. I hope it's a blip. I'm a little I'm a little worried about that being a blip, frankly, from what I've seen so far. And I did want to point out, the World Bank just released a new growth forecast that predicts that growth will slow to only 2.3% this year. This is already nearly 0.5% lower just since January. And if their predictions prove correct, we're looking at an average global growth outlook that will be the slowest of any decade since the 1960s. So even reversing what we've just seen would be extremely hard, because I think at this point, no matter how sensible the policies that may be agreed upon, there is this lingering question of uncertainty and credibility. I think the U.S. has really taken a hit there, and it will take some real time to restore reputation on that front.
Karen, really great to have you with us. Karen Mathiasen, who's a project director at the Centre for Global Development, and even sort of long-standing defence alliances are being reviewed at the moment in terms of how the Pentagon is going to play that out. They've announced that they'll be reviewing the AUKUS military pact to see if it aligns with the Trump administration's America First policy. The $240 billion agreement would see Australia receive US-made nuclear-powered submarines to replace its ageing fleet. Bloomberg's Paul Allen has more. So this has been a big deal, both in terms of the attention, the conversation nationally around it. Is it now potentially at risk?
Well, we shall see. I mean, the UK response so far has perhaps been the most measured and interesting. The UK is saying it's understandable that the US wants to conduct a review. There's just been a change of government. And the UK did exactly the same thing when Keir Starmer came to power. They did a review of AUKUS. But people get nervous, right, when this sort of thing gets announced by the Trump White House, because it does have a reputation for being unpredictable and unorthodox. So here's what we know so far. The Pentagon's ordered this review. See if it aligns with America First. It'll take about 30 days. It's going to be headed up by the Defense Undersecretary Elbridge Colby, who is, well, he has a reputation for being an AUKUS skeptic. But then again, at his confirmation hearing, he said he wants to remove red tape and speed up production so AUKUS can be expedited. So AUKUS does all these things. It ticks all those boxes. And Keir Starmer also said last month that AUKUS is now the centrepiece of UK defence strategy. Considering how close the US and the UK have remained, it would be quite the rug pull to call this off.
Yeah, but we have seen, of course, President Trump really reviewing a lot of President Biden's policies, and this was signed back in 2021 under his team. So what are we seeing in terms right now of, as you mentioned, how it squares with Trump's America First policy?
Well, if you look at some of the other things the Trump White House has been saying, there is a demand that US allies spend more on defence. Well, that's what this is. Australia is significantly lifting its defence spending. AUKUS so far it's going to cost $11 billion just in the initial stages over the next 4 years. That's more than Australia spends on its entire air force, and it's almost like a fourth branch of the defence forces. So it's substantial, and it would see Australia acquire 3 to 5 nuclear-powered submarines, which is a big step up as well. And Australia's already spent $500 million just in the early stages to get the pact rolling. As I mentioned, Elbridge Colby wants to ramp up submarine building. I mean, AUKUS certainly does this. So if it's cancelled, that money is then not going to go to the US to support those next-generation submarines. We're going to have Anthony Albanese having his first face-to-face meeting with President Trump in just a few days on the sidelines of the G7. Safe to say they've now got one more thing to talk about.
All right, Bloomberg's Paul Allen there with the latest on that deal. Other stories that we're following right now, UK Finance Minister Rachel Reeves has announced a funding boost for health, defence and infrastructure in a spending review seen as a watershed moment for the Labour government. The NHS will see a 3% rise in spending in each of the next 3 years, amounting to $39 billion. Reeves also confirmed tens of billions of pounds of new funding for infrastructure and public services.
We are renewing Britain. But I know that too many people in too many parts of our country are yet to feel it. This government's task, my chance, a task as Chancellor, and the purpose of this spending review is to change that.
Rallies against immigration raids that began in Los Angeles have spread to other cities, including New York, Chicago, and Milwaukee, with some clashes reported between protesters and police. In LA, the downtown area is said to be under curfew for a second night. Tensions remain high, with California Governor Gavin Newsom using a TV address to call President Trump's use of federal powers an assault on democracy. Elon Musk has issued his strongest sign of contrition over last week's public feud with President Trump, using his X platform to say that he regrets some of his posts went too far. Sources say Vice President J.D. Vance and White House Chief of Staff Susie Wiles called Musk last Friday to urge him to end his conflict with Trump. Vance now says the president wishes Musk well.
Take a look, Shery, when it comes to what we're watching across oil markets at the moment. We're setting up for a seventh day of gains when it comes to energy and oil supply-related names on the stock market in Asia, at least. We're really seeing oil extending that surge, the Iranian threat ratcheting up, the tensions in the Middle East. After jumping almost 5% in the Wednesday session, again on these spiking tensions across the Middle East, Iran threatening to strike US bases in the region if talks over the nuclear program fall through and if it's attacked. We saw that rally across both WTI as well as Brent. The US ordering some of its staff to leave the embassy in Iraq, allowing military service members' families to leave the Middle East as well. We've also heard warnings from the UK Navy that higher tensions could affect shipping in the region as well. So this really jolts futures out of what has been a pretty narrow range that we've seen over the past months or so, really showing that sensitivity to geopolitical tensions. More ahead on the Asia trade. This is Bloomberg.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
DoubleLine Group CEO Jeffrey Gundlach speaking exclusively to us about America's debt burden. Of course, he's warned about really the veering away from American assets as we continue to see the dollar under pressure, lowest level since 2023. But when it comes to the Treasury space, we are seeing it extend gains in the Asian session after that solid $39 billion sale of 10-year debt overnight, not to mention some benign U.S. inflation data, core inflation rising less than forecast for a fourth consecutive month. So we're seeing that advance being led again by shorter maturities with a 2-year yields, as you can see right there, dropping below that 4% level. For more, let's bring in executive editor for Asia Markets, Paul Dobson. But Paul, we're still headed towards another debt auction, 30 years, $22 billion sale.
Yeah, there's going to be a lot of focus on that debt sale this afternoon. Shery, in fact, bond auctions in general are the new exciting market event because there's been some suspicions that demand is starting to falter, particularly for those longest maturities. And so this 30-year sale will be well watched to see whether foreign participation remains strong, whether the market is prepared to take down the issuance. You know, we heard Gundlach there talking about the concerns over the US debt and deficit, which is swelling, and the Trump tax and spending plans would only exacerbate that some more. And so that's starting to weigh on people's minds, as well as the fact that, you know, there's a lot of other reasons to be a little bit skeptical about the US from a geopolitical standpoint, from an economic standpoint at the moment. I think if you're sitting somewhere else in the world, and we've seen people talking about, you know, putting a little bit of money out of the US markets and putting it everywhere elsewhere there's equal opportunities. And so there'll be a lot of focus on the auction. That being said, the auction that we had for the 10-year securities in the US, which was yesterday, went well by all accounts, and all measures and all metrics showed that there was strong demand, and we're continuing to see some follow through from that into Asia's hours. So maybe it will go well. One of our columnists, Bob Burgess, was saying in his piece That's a disappointment. And I think, Jeff Gundlach would agree with it. It's a disappointment for the bond vigilantes who want to see some more discipline, fiscal discipline from the US administration by protesting and pushing up those yields. And actually that strong demand, sort of gives a little bit of a green light for the US to continue spending with impunity.
What are we seeing when it comes to sentiment on JGBs? PIMCO seeing it as a tactical buy as we see these yields continuing to surge?
Yeah, I think that people overseas are looking at Japanese government bonds as offering a little bit more appeal based on the idea that if the dollar is going to continue to weaken and the yen will be one of the beneficiaries of that, then even if the government bonds themselves, the prices are under a little bit of pressure, you might still get a beneficial effect from the currency. And so we're seeing quite a lot of the international investors talking about them as being appealing. What we're not seeing as much evidence of just yet is that idea that Japanese large insurers, pension funds are going to pull money en masse out of the US and put it back into the Japanese market. We haven't really seen that yet, and that's why those long-end yields have continued to ratchet higher. We haven't got to the point yet where they're suddenly starting to buy collectively. Things have stabilized in recent days, but then there's also been some possibilities or some talk about the idea that either the authorities or the Bank of Japan or might find some way to try to keep those yields in check a little bit. So the market has taken a little bit of faith from that at the same time. But otherwise, until we get to a point where there is more genuine demand to take down those bonds, those auctions there are going to remain under pressure as well.
Bloomberg's Paul Dobson there joining us with the latest on the debt markets. Let's turn to China's bonds because now we're getting the latest headline that Season Group, it's a private builder in China, is marketing dollar bonds. This would be a very rare move and China's first private builder dollar bond offering in years, given, of course, that we continue to see the real estate sector structural decline and also the reduced reliance in the offshore market. We had heard just days earlier that Season Group is considering raising about $200 million to $300 million through a 2.5-year dollar bond offering, and we're now getting the latest lines that they're actually, in fact, marketing dollar bonds. This is Bloomberg.
Billionaire investor Tudor Jones believes that Trump's tax bill poses a threat to stock and bond markets and will spur rate cuts over the next 12 months. He spoke to Bloomberg TV about the bill and his expectations for Trump's Fed pick.
The big, beautiful bill is really interesting. It's first of all, it's a genius in branding. The name of it's a genius in branding. But I think what you got to do is you kind of you have to go to first principles. What would the actual budget look like if we were trying to balance the budget? If we were actually trying to balance the budget, what is the counterfactual to the big, beautiful bill? So if you actually had to balance the budget, it probably would be the big, beastly bill. And at some point down the road, who knows when that's going to be? Maybe it's next year, maybe it's the next administration, maybe it's 10 years down the road. At some point, probably, the bond markets are going to call BS on governments around the world playing chicken with them, right? So to give you an idea, if we were to balance the budget today, let's assume, first thing I would do if I was president, I'd appoint the most dovish central banker I could to lower interest costs. So let's assume that I could make a pact with my chairman of the Fed that I'm going to go through an austerity package. I'm going to balance it, but I need you to really drop rates to, let's say, 2.5%. So if you drop rates to 2.5% and you get a 50 basis point reduction, or let's say even a 100 basis point reduction in 10-year rates, that saves you $175 billion. The starting gap is $900 billion, so that saves you $175. Now I'm down to $725 billion that I've got to find through tax hikes and spending cuts. So let's assume that we're going to do this fairly. We're going to do 50% tax hikes in the rich, because they've benefited the most in the last 30, 40 years, 50% spending cuts. What does that look like? On the spending cut side, I would just to make it simple, let's just call it a blanket 6% reduction in everything. Social Security, Medicaid, defense spending, you name it. I'm just going to cut everything 6% across the board. That's what it would take to get you $360 billion, half of that $725.
Tough to do with Congress, right? You got to work.
I'm just saying there'll be a point where the markets are going to demand it.
Tudor Investments co-chairman and CIO Tudor Jones, a bit of caution across markets on President Trump's warning of unilateral tariffs. This is Bloomberg.